Thank you, Sam and Johnny. And this is Brett Owens here, back from episode 33. As these guys mentioned, we talked about recession-proof REITs at that time. So looking at ways to invest in real estate through the stock market. So looking at real estate investment trust, ways to get cash flow into our portfolios with high yields, but kind of taking that contrarian approach so that we're buying stuff when it's out of favor, so that not only is our downside maybe limited on these buys that we make, but also we've got some upside with prices. So we're going to have another cash flow, high yield focus episode today, and I'm bringing on actually one of my colleagues. We call him the CEF professor. Michael Foster is his name, and Michael is our foremost expert in what we call closed-end funds. So it's a little niche area of the high yield sector. A lot of investors maybe have heard of but are not too familiar with. But like REITs and with other stocks, you can buy them from the convenience of your online brokerage account. So you type in the tickers, they've got prices, they've got regular dividends that are paying out. So that's the attractiveness of this sector. As with other sectors, as with the REITs we talked about last time, there are some great investments and there are also some real dogs that we want to make sure we avoid here as well. So we're going to bring on Michael, talk about the sector in general, and then I want to get his thoughts on some specific picks, including some articles that he's recently written for our site over on contrarianoutlook.com, where we focus on high yield stuff today. So Michael, welcome. Thank you for joining us.
Thank you very much. I'm going to have everyone call me Professor Michael from now on. I like that.
Professor Michael, that's right. And then Professor Michael, so coming to us from Bangkok, Thailand, is that right?
Yes, indeed. I'm one of those annoying people known as a digital nomad, and I've been doing this on and off for about 4 years now. So it's one of the things that I like about closed-end funds. It's one of the things that's really great about high-yield investing is that it makes it possible kind of to quit your day job and get a large enough flow of income coming in to allow you to travel the world. It's basically how I started doing this a few years ago, and so I've kind of become an evangelist since then. I really believe in this as a way to kind of escape the rat race and really take advantage of the income opportunities that a lot of people just don't know are out there.
Yeah, so let's talk about those income opportunities, because if I'm listening to this or I'm talking to you, what I'm thinking is if I want to live off dividends alone from the classic standpoint, we know the S&P doesn't even pay 2% today. A lot of the tried and true dividend aristocrats, they might pay 2.5%, 3%. That's a lot of cash you need to be able to get meaningful income off of those dividends. I mean, we're probably looking at $3, $4, $5 million until you've got any sort of meaningful income. So with your CEF strategy, what types of dividends are you looking at first? And then secondly, since we know there are no free lunches out there, how is it possible then that we're getting those types of yields as well? Where exactly are they coming from in terms of the cash flow from the funds themselves?
Yeah, those are two really important questions. And the reason why I like closed-end funds is that they offer high yields and tend to have safer dividends than a lot of high-yield alternatives because of the really strange, kind of unusual way that closed-end funds are structured, which is fundamentally different from mutual funds and ETFs. So the average CEF yields right now 6.4%, which sounds very, very high, and it is. But actually, some closed-end funds, some of the ones that I prefer, yield much more. Some yield over 10% even, although most of the ones that I prefer at the moment are yielding around 7 to 8%. And so to ask how is that possible, again, it's a very good question because, of course, if you try to withdraw 8% from a common stock portfolio, you're more likely than not going to run out of money unless, and this is very important, unless you're getting a 7 to 8% return. If you're getting a return on your investments that exceeds the amount of money you're taking out of the portfolio, you'll never run out of money. And so what closed-end funds try to do is to make that balance where the fund basically collects a ton of money from different investors, puts that in the market, and then tries to get a return that exceeds the dividend that's paid out. Some funds do it. Some funds have been doing that for over 10 years. One of my favorite funds has returned about 12% over the last decade. Some have returned over the last few years something like 20%, while their dividends are more like 7 to 8%. So if you're able to do that, if you're able to make more money than you're paying out, then you should be able to sustain that dividend forever. Now, it's important to remember that the S&P 500 historically has returned about 8%. So simply put, if you have a fund that can match the market performance and pay out that return over time, in theoretically, it should be able to pay its dividend forever. But it gets even better. And one of the great things I love about closed-end funds, which really ties into, Brett, you have this contrarian style that I very much like, where you try to buy when everyone else is selling and vice versa. This kind of strategy works really well with closed-end funds as well, because very often they trade at a discount to their net asset value. I don't know, do you want me to dig into that a little bit?
Let's get into that. I think that's a good next point then. So let's talk about the structure of a closed-end fund. So a lot of people are familiar with, of course, mutual funds, exchange-traded funds or ETFs. Closed-end funds. So where do they fit in the picture? And then, as you mentioned, and then let's get into that discount in terms of how that's possible and how that's unique to the CEFs.
Okay. So, basic way to think about it: closed-end funds kind of follow the same basic premise as a mutual fund or an ETF, where you get together a bunch of money from a bunch of different investors, and then you put all that money together into whatever asset class that fund is specializing in. So you have U.S. stock closed-end funds, U.S. stock mutual funds, where they take all this money together and invest it in U.S. stocks. You have funds that also focus on corporate bonds or REITs that you know a lot about. There are some that do more exotic things like covered call strategies. Some do MBSs, which of course, really famous back in 2008, 2009 for pretty horrific reasons. There are also ultra safe closed-end funds. There are municipal bond funds. There are preferred stock funds. There are a ton of different types of closed-end funds. And what they basically do is they attract all this money and put it all together and then invest it in whatever the fund specialty is. However, there's one little difference between a closed-end fund and a mutual fund and an ETF that makes it very attractive. When you buy a mutual fund, it is impossible. It is against the laws of finance and physics. It is absolutely physically impossible to ever buy a mutual fund for less than the mutual fund is worth. Right? If I'm buying $10 into a mutual fund, I'm getting $10 of assets. With ETFs, it's kind of the same thing. It is possible to buy an ETF at a discount, but usually ETFs don't trade for much less than what they're worth. I'd say usually 2% is an extreme discount with ETFs. But with closed-end funds, actually, closed-end funds very often will trade on the open market. And remember, you can buy and sell these like stocks. So you can buy them and sell them on the same trading day if you want to. These closed-end funds can very often trade at huge discounts to what they're actually worth, 10%, 15%, sometimes even 20%, which means if you buy $1 worth of a closed-end fund, if you spend 80 cents of a closed-end fund, you're actually getting $1 worth of assets. And there are a lot of closed-end funds that are trading significantly lower than what they're worth, which is really one of the great things about these funds, is that you're essentially buying assets on sale. There are a couple of closed-end funds, again, specializing in U.S. stocks that hold things like, the famous FAME stocks, Facebook, Apple, Google, Microsoft nowadays. And you're getting all of these really great companies for less than you would get if you bought the individual stocks on the stock market. all because
Right.
of the
Yeah,
way.
I've always found that to be a attractive part of the CEF world, as well as you mentioned. I just pulled up Gabelli Dividend and Income Fund. That's one we've written about from time to time, and some of the reason we like to kind of reference it is because they own basically good dividend stocks. That's what they do. The
Hmm.
irony is that it's traded at a 10% discount on average to its net asset value over the last 3 years, which means, as you mentioned, you're buying these stocks for 90 cents on a dollar, and these are not obscure stocks. They just happen to own um, Wells Fargo, whatever, but you're getting it cheaper by going through the closed-end fund, which is um, kind of kind of ironic in that respect. So you're getting you can get a good deal if you time them well, if you time them when those discount windows are more open, especially than they usually are. So let's talk about the universe then, Michael. How many of these things are there? How many are we looking at with stocks? I think we're down before we were before, but we've got about 4,000 or so publicly traded stocks. I think that's a joke. The Wilshire 5,000 doesn't have 5,000 anymore. How many of these CEFs are there out there?
Yeah, so the number actually doesn't move all that much because closed-end funds are a pretty small niche. Frankly, there are a lot of investors out there who don't know they exist. There are about 600 closed-end funds right now, depending, some are more structured as companies, some are more structured as funds, but there are about 600. And I'd say about 100 of them aren't really worth paying attention to. They're too small, they're too illiquid, they're about to merge with other funds. That happens quite frequently. So really, you're looking at about 500 funds that you could theoretically, and what I do all the time, pay attention to pretty much on a regular basis. And when you're paying attention to these funds, what you want to look for is, I was talking about how the funds can trade at a discount, and like the fund you mentioned, there are a lot of funds that will trade at a discount to its net asset value for years. Some have always traded at a discount. So even if you buy that fund at a discount, it doesn't necessarily mean that you're going to make money. It could stay at the same discount forever. But some funds will go from trading at a huge discount to trading at the net asset value to even trading at a premium. So, if a fund has a 5% premium, for example, you have to pay $1.05 to get $1 worth of assets. And that's one of the strategies you can take with closed-end funds. In addition to getting that 6.4% average yield or 10% yield in some cases, you're also trading closed-end funds by buying them when they're at a big discount and then selling them when they get to net asset value or to a premium. And that's something that I've been doing personally for years.
Right. So what's your strategy in those cases then? So you see a fund, it's at a 10% discount, it's at a 12% discount, hey, it's at a 15% discount, and you're looking at it where you think the yield is safe, plus you're looking at that discount window closing as upside. So what are you in particular looking for from that fund or from the market in general to be able to close that discount window? So are we looking for buybacks from the fund itself? Are you banking on broader sentiment turning around there? Is there some sort of combination of factors that you're looking at? What's sort of driving that decision when you look at that window and you say, hey, that window is probably going to close. I'm going to make some money off it while it does, but it's going to close soon. That's why I'm going to buy now.
Yeah, there are a few metrics that I look at. I think one of the most important is the sort of cyclical indicators within the fund. So the way to think about it is a fund will tend to oscillate between trading at a discount to trading at a premium. Very often, this has nothing to do with with any changes in the fund or the asset class. It can be pure dumb luck. Actually, I've been looking at a couple of municipal bond funds. One of them, they're both New Jersey specialist municipal bond funds. They're both run by the same management company even. These two funds trade in the same stuff and they're managed by the same people. They're almost identical. And both of them have gone up about 5% in 2017. But one of them has, the market price has gone up 4%, in 2017, while the net asset value has gone up 5%. And the other one has gone down 8% in 2017 by its market price, while its net asset value has gone up 5%. Those are the kinds of disconnects you want to look for. That's a classic example. And so what you want to do is you want to buy the fund that's market price has gone down 8% this year while its net asset value has gone up, and then wait for the market to realize, what the hell have we done? We've overbought this fund A that's identical to fund B that we've underbought. We need to go buy fund B. That happens all the time with closed-end funds. That's one way to do it. One other way to do it is there are some funds, one of my favorite, and I know, Brett, you've liked this one in the past too, PIMCO Dynamic Income Fund, PDI. Back at the latter half of 2016, was trading at a discount to net asset value, which is pretty uncommon for the fund. And then it swung up to a premium. And it did that in the span of about 3 months. So you can find a fund that has suddenly dipped far below its average premium or discount, buy it then, and then wait for it to revert to the mean. And this is another strategy that works very, very well.
Yeah, that's a great one. I've noticed you've written about that with the PIMCO funds. I noticed that with the couple of the double line funds, wrote about those last year. Jeffrey Gunlash, Bond God dude, they basically have 2 close-end funds, and they both have the same mandates. So he can buy whatever the hell he wants in either one of them. DBL is one, and that trades for a 12% premium to its net asset value, while DSL has kind of been the stepchild, trading at a discount. So it's interesting because DBL basically traded, they both paid huge dividends. They both pay 8, 9 plus percent. DBL basically traded flat as a total return over the last year. Not that it did anything wrong. It still paid its dividends, but it was at such a high premium that the thing, even with the big yield, just traded sideways, where DSL did exactly what you look for, where it paid that dividend, it paid that 9, 10%, and then also ran up 20% because that discount window closed, and also the net asset value increased a little bit along the way as well. So I guess one of the reasons, Michael, that I find a lot of these opportunities are available is just the size of these funds, where we're mostly looking on the smaller end, right? What are the typical sizes of these funds that you're looking at? And then as a follow-up to that, then what types of investors are we looking at? Are we looking at institutions buying these things, or really more individual and retail investors?
Yeah, so those I think are really key to understanding the closed-end fund world, because a lot of these funds are really too small for the big institutional investors to buy. A lot of these funds have a market cap or total net assets of less than $200 million. There are a few that are over, let's say, 700 million would be the cutoff point for the top 100 closed-end funds, and there are a few that are over $1 billion in size. But the smaller ones are simply too small for a lot of institutional investors to get into. There are some specialty institutional investors that do try to buy closed-end funds and then shake them up and affect change. Frankly, they're not very good at it. The City of London, of all places, has been trying to do this. They've been buying up a bunch of closed-end funds in the hopes of shaking up management and squeezing some value, basically making that discount to net asset value disappear. But that hasn't really worked. Another institution that does this quite a bit is Bulldog Investors, but their track record is pretty hit or miss as well. And part of the reason for that is that a lot of closed-end fund momentum is really retail investor driven. It's one of the rare parts of the stock market left, I think, where inefficiency reigns supreme. One of my favorite examples of this is, you'll tend to notice PIMCO's California municipal bond funds trade at huge premiums to net asset value, but their New York and New Jersey funds tend to trade at discounts. You know why?
I don't. I'm stuck in those California funds.
The funny thing is, it really makes you laugh. It's such a stupid reason. It's because PIMCO's based in California. Their sales force, their ability to sell these funds to retail investors is really California focused. Likewise, BlackRock's East Coast funds, because remember BlackRock is based on the East Coast, their East Coast funds tend to trade at higher premiums, and their California municipal bond funds tend to trade at discount. Again, because they don't have the sales force there to sell these funds. This is a massively, massively inefficient market, and that's really where one of the big opportunities comes for investors.
That is funny. So where is Nuveen based? You got me turned on. I actually own that, so I own that Nuveen California fund, NAC, for my fellow Californians out here. So it's got a nice yield, and then as Michael pointed out a few months ago, is actually trading at an even bigger discount. Are they? I always see their signs up at Wrigley. Are they out of the Midwest, Nuveen?
They are. They're based in
Okay.
Chicago, which again, it's funny with Nuveen because you've seen instances where you'll get, and one of the reasons why I liked that California fund a while ago, and I don't know how much it's up since then. I think like 6-7%, right? But one of the reasons why I liked it is because when you compared that to one of their Pennsylvania funds, both of the funds' net asset values had gone up about the same amount, but one had swung from a huge discount to a premium, and the other one had gone from a small discount to a bigger discount. So obviously you take the one with the bigger discount, and that one's outperformed the one that swung from a premium when I first saw this. And these kinds of pair trades happen all the time. However, one thing I always try to encourage people to keep in mind is that you can't just choose a closed-end fund based on a discount. That's, I think, the biggest mistake that people make with closed-end funds. There are a lot of factors that you have to keep in mind. The discount's the starting point. You also need to look at the quality of management. You need to look at the fund's portfolio. You need to look at the fund's mandate. Does it invest in good assets? Is it overextending or overusing leverage? Is it out-earning its dividend? Has its net investment income gone up or gone down significantly lately? Is it earning capital gains by churning the portfolio? What is your outlook for that particular asset class, right? Because if you were really bullish on muni bonds in the middle of last year, by the end of the year, you would have been down no matter what fund you chose, whether it was closed-end fund or ETF or whatever. So it's got to be a combination of a lot of things, a sort of macro perspective, a close look at management, a bottom-up look at the portfolio, as well as this kind of cyclical analysis of, is the fund trading at a bigger discount than it used to? Is it now trading at a premium? And where is that going to go in the future?
Right. Absolutely, about the quality of the management. One little trick that we like to tell our subscribers who write in, and they'll ask about maybe a random CEF that they pulled up. If for listeners who want a quick way to have a sanity check on management, honestly, past performance in this sector I found is a very good indicator of those future results. So I know stock market, maybe not so, but here you're looking at a management team and you want them to consider consistently grind out those high single-digit returns year after year. So how they did in the past is a good indicator of that. And what I would encourage you to do, any CEF you're looking at buying, pull up that chart. Just be careful that you're looking at the total return with dividends, because you want them to get credit for the dividends. So a lot of times the price may decline over time, but your total return is going to be up because of those big yields. So pull up that total return and just look at it over any time period. So you can look at it over 5, 10. Some of these funds have been around longer. Some of them have 20, 30-year track records. Look at that track record, and then it'll show over a 30-year period. Have they done well? Some funds have returned 8, 9% over the long haul, and they've been paid that dividend and then giving you a little bit of cap gains to boot. And some funds never make money. All they do is lose money, and you'll see. And usually they don't have that long track record, but you'll see they might be 5 years old, and all they've done is pissed away investor money for 5 years. So that's a good quick check, is just to see, just plot that total return, just to see what that fund has kind of done over time. So, Michael, let's get into a couple. I want to get in one of your recent articles here and get into a couple of your picks we can share with listeners here. So, you recently wrote an article for our site here, very popular one, 9.9% yields every retiree must own. So, basically, you're making the case that, all right, if we really want to retire, what do we need in terms of passive income? And the number you were using was $44,830 a month. So nice little starting point in terms of, I'm sorry, per year. We'd be doing very well if that was per month. But that's what we're breaking out per year and then looking at how we're going to get that. So let's take a look at that because you're looking at funds that are with yields actually starting at that 9.9% mark, so mostly double-digit yielders. So what types of funds are we looking at here that are going to give us those types of payouts?
Yeah, so in this article, I look at 10 different funds that have a bunch of different investment strategies. So you've got the Western Asset Mortgage Defined Opportunity Fund that focuses on mortgage-backed securities. You've got the MFS Intermediate High Income Fund, which is intermediate corporate bonds. You've got an MLP fund. You've got a couple of dividend stock funds. So it's really a diversified portfolio across different asset classes. But the most important thing to keep in mind with this is what I call the liquidity of the portfolio. And what I mean by that is you need to think about your cash needs when you're looking at retiring or you're looking at actually using this passive income stream. And you want to have a portfolio that is going to provide you enough cash so that you don't have to sell any stocks. This is a very, very important consideration that a lot of people, when evangelizing about index investing, conveniently forget about. And, people forget about this now because we haven't had a market downturn in about a decade, right? But the fact of the matter is, if you just buy an index fund that yields 2%, and you plan on using 7, 8, 9% of your portfolio to fund whatever, your rent, your food bill, travel, whatever you want to use that money for, you're going to run out of money. And it's something that I talk about in this article, how if a retiree had done the quote-unquote right thing and did index investing with a $1.2 million portfolio in 2008, that would have plummeted to less than 700,000 in 2009 because they were taking money, they were selling shares while their shares were going down in value. Now, closed-end fund,
the old reverse dollar cost averaging, right? You dollar cost average is you're building your portfolio, you're doing great, you're buying more when you're low, and then and then if you retire and you're trying to do this 4% withdrawal nonsense or whatever you're trying to do, you're doing exactly as you said. You're selling more when prices are low, so you're actually destroying your capital faster than you otherwise would. So that's the reverse dollar cost average. Absolutely what you want to avoid when you're trying to live off of your capital.
Yeah, and I think the one common thread in a lot of hate mail I get is that, well, why don't I just index the market and wait 30 years and I'm going to have a huge return? And yeah, you probably will. But what if you need the money before 30 years? What if your timeline is 5 years or 3 years? One of the reasons why I got into this is because I was, I was a professor and I didn't really like being a professor. And I wanted to find a reliable income stream that could get me enough money that I didn't have to work within 5 years. Closed-end funds provided that opportunity and actually helped me to, leave the workforce early. That's the thing about index investing is that, yes, you're going to get a strong return over a long period of time. You can get that too with closed-end funds, and there are plenty of closed-end funds that have crushed the S&P 500 for a decade that we can talk about in a bit. But while you're doing that, you can also get enough cash in hand, cold hard cash, to use to pay your rent, to pay for food, your cable bill, whatever, so that you don't have to do that reverse dollar cost averaging that gets so many people in trouble. And that's a hard thing for people nowadays to understand because, you know, the 2008, 2009 crisis was such a long time ago. But I remember it very clearly, and it's something that I don't want to have to sell shares in a bear market. I don't ever want to have to face that choice because, you know, as I talk about in this article, it kills your net worth.
Yeah, with that, so let's get into the most recent article you wrote for our site, which kind of gives you the best of both worlds, where you've got some funds that not only perform with the market, but they actually beat the market. So you're looking at 10 funds here that are going to give you not only what that indexing strategy would have given you, but they're going to beat that, but they're also giving it to you in yield. So you've got cash flow now. You're not sacrificing any long-term types of returns. So let's talk about these funds, because these are, to me, these are this is where it's at. These are really, you know, special types of management teams and strategies to be able to beat the broader index while still paying these yields, because that's not really, I would say, maybe not quote unquote supposed to happen. You buy high yields for those dividends now. The thought is that you're sacrificing long-term returns, but with these 10 you're talking about here, you're not sacrificing anything. It's actually, it would be superior in every way to just buying that old S&P 500 index fund. So let's talk about how are these funds able to do that?
Yeah, that's so in this article, I talk about that there are actually more than 10 funds. There are a lot more than 10 funds that have beat the S&P over the last decade. And there are even more funds that have beaten the S&P over the last 3 years or 5 years. The reason why they haven't beat it for longer is because those funds have only been around for 3 or 5 years. There are quite a few new funds in the market that have been absolutely killing it. And there's really no common thread. You know, there's nothing in common. We've got some bond funds, we've got some stock funds here. We find PIMCO is, if there's any common thread in these funds, it's PIMCO. PIMCO has an absolutely killer team of investment professionals. I've met quite a few of them professionally, and it's always a very, very intellectually stimulating experience talking to these guys. They really, really know the market very well, and the proof is in their constant outperformance. But it's more than just that. It's also access to market. So, you know, one of the classic things that, you know, when people tout, you know, the vast majority of funds don't outperform the S&P 500, there are a lot of flaws in the comparison. The one flaw that I think annoys me the most is that maybe when you look at just U.S. stock funds compared to the index, a lot of them cannot beat the market. But there are a lot of funds out there that invest in things that you or I cannot easily invest in. And if we tried to, we would get our asses handed to ourselves, frankly. If we tried to buy municipal bonds on the muni bond market, or we tried to get convertible bonds, even if we tried to get a preferred stock, we're not going to have access to the kinds of investment opportunities that are available to a big company like PIMCO, because of their relationships, because these are not open exchanges where you can buy and sell in a matter of milliseconds. It's much, much harder to get these assets, and it's those different, more exotic kinds of asset classes that have been beating the S&P 500 for a long time, partly because they're so hard to get into.
Yeah, one of my favorites, as you know, in your piece here, and again, a good example of every fund a little different, not only in their strategy, but how they carry it out. QQQX, which sells covered calls basically on NASDAQ stocks. I was really surprised when I found it and was researching it. At the time, it was trading at a discount. This wasn't too long ago. It was only about 6 months ago. Trading at a pretty big discount to its net asset value. And over its history, it had actually outperformed the NASDAQ itself. So in theory, you buy the NASDAQ, you want the upside of tech stocks. This fund had a safer strategy where they were buying basically NASDAQ stocks, selling covered calls on them, which is supposed to be a conservative strategy where you're taking cash flow now, you're selling call options, which means you're trading in some of the upside for some option premium, so you're collecting cash. That's why the fund was able to pay a big dividend. It's coming from that cash that they're collecting with the options. Well, lo and behold, over a long time period, it's outperformed the NASDAQ itself. So it's kind of that best of both worlds where you're able to see a fund that it's going to give you that cash flow now, but also those long-term returns. But to your point earlier about discount windows closing, the thing's trading at a premium now, so it's kind of rocketed through. So it's above where I would recommend buying it today. But again, something to keep an eye on as it swings back and forth, like you said. So Michael, let's get you out of here on this while we show folks how they can get a hold of you, follow your stuff. So you've got couple columns a week you're writing for our Contrarian Outlook site, and then we've also got a new newsletter for you as well. In fact, the only CEF-focused newsletter that at least I'm aware of in the industry, CEF Insider. So can you tell people how to follow your CEF writing on a regular basis?
Yeah, I think probably the easiest way is to go to contrarianoutlook.com. You'll see my articles there. And if you're interested in learning more about CEF Insider, you can click on Premium Newsletters, and I believe it's a link at the bottom of the page. Scroll down and you'll see a link there as well. And just to explain a little bit about what we do, we try to look for closed-end funds that yield on average about 7 to 8% with the opportunity to get capital gains of about 10% within a year. We launched really just a couple of months ago, and last I checked yesterday, the portfolio was up an annualized 28%. Yeah, so we're up on average about 5%. Yeah, up about 5% since we launched. So it's doing quite well, and we're going to be making more recommendations in the future, so I hope you check it out.
Yeah, it's amazing how it can really snowball where you're getting your big yields and then you get some cap gains on those discount windows closing. They can close fast as you've picked, as I've seen, and it's really an interesting strategy. So yeah, listeners out there, CEFs, definitely that little underappreciated sector of the market. You can get your cash flow now, and you can really do pretty well in terms of total returns as well. So thank you, Michael, for joining us and staying up late with us here in the U.S. Appreciate you having the long night over on your side. So we'll let you get out of here and kick things back to Sam and Johnny. But thanks again, Michael.
Cool. Thanks, Brett.